Guys, it's Mrs. Lamphere. We are looking at section 3 of unit 4, posting journal entries to general ledger accounts. So in the last section we talked about passing journal entries, so we moved from using our T accounts to then copying those transactions over into the general journal. So now we're going to go from copying the general journal transactions over to the general ledger. So that is the next step in our accounting cycle. So we just did journalizing each transaction in the general journal. Now we're going to post the journal entries into the ledger accounts. So let's get started. We can skip over these first couple pages. Okay, so the general ledger is a collection of assets, liabilities, revenue, and expenses. It is a permanent record of the financial accounts, including owner's equity accounts. These entries in the general ledger are organized by account number. So basically the ledger is this big huge book, and each page will represent a different account, whether it's an asset account, a liabilities account, a revenue account, so on and so forth. When we're posting into the general ledger, posting is the process of recording the appropriate part of the journal entry into the affected ledger account. So when we're looking at the journal entries, we're going to look at the two accounts affected and then post each of those that transaction into each account's general ledger. By posting a transaction, you record the impact of the transaction on the different business accounts. So if it was a debit, we're going to record it over in the ledger as a debit. If it was a credit, we're going to record it as a credit in the ledger as well. For example, a car dealer records all business transactions in the journal and posts the journal to the general ledger. An up-to-date ledger allows the dealer's accountant to give a management information regarding sale of cars, service income, and salary commission expense. So again, what the ledger does then, it kind of summarizes what was in the journal, and it lets us look at, so if we're looking at the cash ledger account, we're able to see all the cash transactions right in a row and can tell instantly what the balance of our cash account is. Same for all accounts. Okay, the ledger form is a 4-column ledger account form, and we'll show you an example of that here in a second. So after journalizing, the transaction should be posted in its respective ledger. It has 4 columns, so 2 sets of debit columns and 2 sets of credit columns. We're going to use 1 set of columns to record the transaction and then the other set to record the balance. So let me just show you real quick what that's going to look like. So this is our representation of a general ledger. Each one of these then would be a different page in the ledger. And so say this is our page for our cash account, and we record every transaction from the journal into our cash ledger, and then you'll see these are the 4 columns that they're talking about. We're going to have 2 columns for recording whether it was a debit or a credit for each transaction, and then these 2 debit and credit columns are the balance then of our account. So since cash is an asset account and its balance is recorded on the debit side, you'll see that the balance is recorded in the debit column over here. Let's see, let me show you an example. Here's accounts payable. So we recorded the transactions from accounts payable into these first debit credit columns, and then we record the balance over here in the balance column. So the balance is the overall balance of this account at that point. So after this first transaction, when we credited $2,000, we had a $2,000 balance. On the 17th of January, we paid $500, so then we have a $1,500 balance left on the account. Let's go back up here to cash, same type of setup. We debited $5,000 to start with. That gave us a $5,000 balance. We paid $400 to something on the 10th, so that gave us a $4,600 balance. We paid $500 on the 17th, so that left us with a $4,100 balance. So after every transaction, you record what the active balance is then. So at the end of the month, we currently have a $4,800 balance in our cash account. So that's what the ledger accounts look like. So the ledger account was posted according to the following equation. That's fine, we've covered that. Remember, assets and expenses have the debit balance along with withdraws. Not sure why they didn't include withdraws there. Liability, revenue, owner's equity have a credit balance. Okay, so make sure you use those that reference guide that I have sent out for you, and that will help you remember the balance sides of each of those accounts. When a transaction occurs, its details are recorded in a journal. Then the only effect of the event on a specific item is recorded in the ledger. The journal is updated on a regular basis while the ledger is posted only periodically. So depending on the type of business and how the size of the business, you record all your transactions daily. So the daily transactions get recorded in a journal, and then the ledger might just be updated weekly or monthly, or depending on how big your business is. So let's watch this quick animation. So this is just showing you what a ledger setup looks like. The account name goes in this column, the account number over here, the date the transaction occurred, okay, I hope that, I'm not sure if that voiceover came through on this recording, but he was talking us through each of these columns on the general ledger. So the only one I didn't, well, I think they talk about the post reference column here in a second. Let's see if they do. Okay, posting journal entries to a ledger account. Follow the steps below to post journal entries to the ledger. First, you're going to open a ledger account for each account listed on the chart of accounts. So I've shown you the chart of accounts that we've used on several assignments before, and you've probably been wondering what the numbers are next to each of those accounts. Well, this is where they come into play. So for instance, with this is kind of looking ahead to the next assignment, but this is our chart of accounts, okay? And then you open a ledger for each of those accounts. So we have a ledger open here for each of the accounts. We have the account name and account number, and then this post reference column. And what goes in the post reference column is reflects the page number that we took this transaction out of the journal. So when we look at our journal here, we see this is page 1 of our general journal. So because once we start listing a lot of transactions throughout the year, we're going to get a lot more pages in our journal. So we always want to record what page we took this from out of our journal. Okay, so open a ledger account for each account listed on the chart of accounts. Enter the name and of the account in the top and the account number. Post each transaction activity from the journal to the appropriate side in the ledger account. So once they've recorded once they've passed a journal entry, this is where you then go and record that into the general ledger. Okay, some classifications of ledger accounts. It can be into 2 categories. Basically, we've talked about temporary accounts and permanent accounts before. So a ledger account with an opening balance of 0. The opening balance of a ledger account will be 0 at the beginning of each accounting period. So we talked about how temporary accounts get closed at the end of each accounting year. And so those accounts will then start with an opening balance of 0. So we talked that revenue and expenses and withdraws are all temporary accounts that get switched over to the owner's equity. So those revenue, expenses, and withdraws will start with a 0 balance at the beginning of the year. Ledger accounts with an opening balance, again, that was all those permanent accounts that we talked about. So fixed assets, capital accounts, accounts payable, those balances will carry over into the next accounting period. Okay, so why do we post entries to the ledger? Well, a ledger account is used to provide management with the following information: the outstanding amount for accounts receivable or accounts payable on a specific date, and the balance in the bank account. So like we showed you, it gives us an up-to-date balance of what each of our accounts is. So at the end of the month, we can look at all of our accounts payable together and see what we still owe. Or we can look at all of our accounts receivable together and see who's missing payment to us. So again, it's kind of like a summary of the balances of each of those accounts. Okay, posting a general journal to the ledger. Posting is the process of transferring the information from the journal to the ledger and updating the ledger accounts as to the effects of the transactions recorded in the journal. So keeping that balance updated. Like I said before, the frequency of posting depends on the size of the business. Let's look at this example here. So on January 5th, Mr. John invested $50,000 in his business by depositing a bank check. In this transaction, 2 accounts were affected. He invested $50,000 to his business, so we're increasing cash and we're increasing capital. In this example, cash and bank account number is 1.2 and the capital account number is 3.1. The first step is to pass the journal entry and then post the general journal entry into the ledger account. So here's the journal entry. Okay, you have the cash increasing with $50,000 and capital increasing $50,000 as a credit. And you'll see they put in a post reference here with the account numbers that these transactions correspond to. So this cash and bank transaction is going to affect account number 1.2. Mr. John's capital is going to affect account number 3.1. So now we go and they have a ledger account open for each of these different accounts. So our cash and bank account, account number 1.2, on January 5th was debited $50,000. So it has a debit balance. Again, these last 2 columns are the balance columns. So we have a $50,000 balance in cash and bank. Mr. John's capital was the other account affected. We have a credit of $50,000, and so we have a credit balance in our capital account for $50,000. The date is when the transaction actually occurred in the business. So when you go to record, so again, you might not post to the ledger every day. So even if it's like a week later, you're still going to transfer that same date over into the ledger account, the date that the transaction happened. In the description column, write details about the sources of documents in this column or leave it blank if no information was available. So if it tells you check number 105 or memo 11 or whatever source document that we talked about, that's going to go in this description column here. Posting reference, this is used to identify where the journal entry is recorded. So on the ledger account, we're going to enter the number of the page number of the journal entry. And the page number appears at the top right corner of the general journal page. So again, in the ledger account, they should be posting the page number in this post reference column. And then the debit or credit amount, so not just the amount for the transaction, but then the balance as well. Compute and record the new balance in the appropriate balance column. So again, it's really going to be vital that you remember, okay, capital account, that's an owner's equity account. The balance is recorded on the credit side. Cash and bank, that's an asset account. Balance is recorded on the debit side. Okay, posting helps organize business transactions into proper accounts. So again, like we said, it lets you kind of, at a glance, see all the transactions for one account on one page. In a journal entry, you cannot summarize similar transactions into one document. So posting allows you to summarize all the business transactions. So here's a big, long journal entry, a month long, and then here is, so they took all those cash and bank transactions, and this is looking at them through the general ledger now. Okay, so we're seeing, we can instantly know that we have a $54,000 balance in our cash account. So we wouldn't have been able to tell that just by looking at the journal. We had to record that over into the ledger because we can see we started with a $50,000 balance and then we ended up with a $54,000 balance. So that's a good sign. We made money. Yay. And office equipment, you can see the value of your office equipment at the end of the month. And like here, so this was an accounts receivable. So someone bought something from us on account for $200, and then they paid that off. So this account doesn't even have a balance right now because it's all paid off. Okay, so again, these are just different ledger accounts for each of the accounts that were used in this journal above. Okay, that's what posting looks like. Okay, to compute the account balance, you just need to remember these simple rules. Debits are added to debits, credits are added to credits, and debits and credits are subtracted from each other. After you have posted to an account, compute the new account balance as follows. When the existing account balance is a debit, add the amount if the amount is posted as a debit. So basically, and it's hard. I'm a visual learner. So what they're saying is, for instance, in a cash account, which is an asset type of account, debits are going to increase our account. So we will be adding debits to each other and then subtracting credits from the debit. Or you could add up the credits together and then subtract them from the overall debits. Whichever is basically saying, remember which side is the balance side. And then so if it's a debit balance side, you're going to be adding the debits and subtracting the credits. That's basically what it's telling you. Or if it is a credit balance side, you're going to be adding the credits and subtracting the debits. Okay, and then this is just an example of showing you a ledger account that has a zero balance. So like we showed you before, this is that accounts receivable. Someone bought something from us on account for $200, so it gave us a $200 balance in that account. And then on January 27th, they paid it off. So we can just record it. You could just put a dash or a zero in that debit column just to show that there is no balance in that account. Okay, in the next video, I will cover the trial balances, but that's it for ledger accounts. But the next step is to then copy the balance of our ledger accounts over into this trial balance, just as a way to make sure that we don't have any errors in our transactions. So stay tuned.